Thank you for watching this video. Many of us, including advisors, ask this question: is it right time to invest? In this video, I first try and assess the performance of the first half of this financial year. I try to explain the risks using our proprietary model in various different asset classes, and I give you enough update on valuations of various asset classes and try and explain those asset classes that are looking cheap and good to invest for the next few quarters and years to come. Now I shall shift to a presentation mode.
The contents of this presentation are the performance of various markets till date, the risk framework that we use at Augment Capital Advisors, valuations of equity, a little deeper into risk premium, primarily basis equity, debt valuations, USD gold, study about USD INR chart, and summary of the valuations of various asset classes. So on the equity, the performance for this financial year 2021 till date has been pretty good, primarily because post-COVID, in March, from March, Sensex has given a return of about 29%. The best performing large cap fund has returned 38%, as against the lowest being at about 15% or so. The good news is 40% of the funds have beaten index, and most of them are, in a good 5 to 6% kind of a range. And many of the funds are still at about 29%, which is beating Sensex returns. On the debt side, interest rates have cooled off, but only by about 11 basis points before falling to 5.75% in the interim. And therefore, the dynamic bond funds and gilt funds have not given great returns this half of the year. Plus, on the corporate bond and credit fund category, the returns have been pretty sporadic, right from a negative 2% to positive 6.7%. Gold has had a good run this year with a return of close to 17%, and the year-on-year return standing at about 32%. While it is still trailing USD gold, primarily because USD INR has cooled off a little bit. USD INR corrected by 2% in the last 6 months, but it is still up 4.5% year-on-year. So before getting into how we value asset, I thought I'll just touch base upon the risk per return framework that we follow at Augment Capital Advisors, which is inspired from legendary investor Mr. Howard Marks, who's also the co-founder of Oak Tree Capital Management. So according to him, there are two most important things an investor needs to be successful. So one is he needs to manage his risk well. Second is he needs to know where we are in the market cycle. So the risk per return framework, where we try to assess the risk for the kind of return that one generates, going by the past data, helps us to understand or manage risks slightly better. In the market cycle, for us to assess which market cycle are we in, we try and use relative valuations. So on the large cap side, we have over 22 years of data, and it clearly shows that the valuations are already stretched. It did fall to below 20 levels in the recent days when COVID news spread out, but we have seen a splendid V-shaped recovery, thereby pushing the valuations back to high zones or so. On the mid cap side, again, valuations were attractive before COVID. It became even more attractive, and right now they are looking fairly valued. On the small caps, the returns were very, very low before COVID. It was at 11-year low. COVID pushed it even further down. Today, we see that even after a splendid rally in the last few quarters, the valuations look very, very attractive. So let me delve a little deeper about how we assess, or relatively assess various asset class. So first is on the left-hand side top, you would see large cap valuations, and you can see that the numbers were at about 87% as against a GSEC fund, which is very, very attractive when COVID happened. And right now it has moved down to a much lower 59%, which ideally means that it is no more attractive. On the right hand side, you can see mid cap valuation, which were at about 75%. and right now it is about 47.43%, which is not attractive, but I believe that there is some data lag, and maybe we will watch this space for some more time before taking a call on mid caps. And clearly, as you can see at in the bottom left, clearly small caps are looking attractive even on a relative asset basis. This is a chart of our 10-year GSEC yield. One needs to look at orange line and blue line. So orange line is an indication of what the trend is, and whenever the blue crosses orange line, it means that the yields can shoot up and one should exit a long-term bond that they hold. Right now, it is below the orange line, so we believe that the yields can continue to go down, but the gap between the orange and the blue is narrowing, which means that we might see a spot of volatility before it continuing its trend or changing its trend in the coming days or so. One good point is RBI has been watching yields very closely and are behind um, to get the yields lower and lower. USD gold chart, we have it for over 29 years now. Again, going by the principle of orange and blue line, as I mentioned earlier, there is no volatility. I mean, there is volatility that one can expect, but we don't expect gold to substantially come down. We believe that this being a risky asset, many debt investors will move to USD gold or INR gold primarily because it's a cheaper asset. One needs to note the fact that USD gold has not returned anything, absolutely zero, in the last 9 to 10 years or so. So, though in INR terms it is expensive, it looks expensive though, but then when you look at the base currency of USD gold, it is definitely extremely attractive. And finally, on the USD INR, the rates are very, very narrow. It's been going between 70 to 74, 75, and we believe that this phenomena will continue for some more time before it continuing its upward journey. So in summary, large caps looks pretty stretched on standalone basis and also not very attractive on risk premium basis too. It's currently a hold call with no entry, but probably we might exit if it trends higher in the next couple of months or so. Mid-cap valuations are moderate, not very attractive. Fundamentals are becoming very slowly but certainly attractive. Hence, the call is to add systematically. Small caps, as you would have sensed by now, it's very attractive at standalone valuation basis. It's very attractive even on a relative basis. So one should invest and spread the money in very short period. And I also have defined exits because small caps are volatile and the returns can vanish away in no time. On the debt side, yields on 10-year are attractive, but inflation being sticky is a small concern that we see. So one can allocate small chunks in dynamic bond funds, with others can be invested in attractive credit rated companies. And finally, on gold and USD INR, gold is attractive, it is cheap, and one should either invest in bulk or spread the investment in 2 to 3 tranches max. USD INR looks to be stable, and hence one can look at adding international equity at this current levels or so. Hope you like this video, and please do feel free to contact us, and we are present in Bangalore, Mumbai and Hyderabad. You have a great day ahead.